What's up, gang? Steven here from the 12% Solution. The rule of thumb for today is to not settle. So your retirement account is making, let's say, 6% a year, and you're feeling pretty good about that. And you're happy because it's a moderate risk, and after all, you certainly don't want to lose money. That is the very definition of settling. You might be thinking, why go to the trouble to earn an extra 3 or 4% on my return if I'm already getting a solid return each year? Why indeed? That's the subject of today's video. Why it is vital to push for the higher return and get the extra 3 to 4%. First, let's start with what you can achieve with virtually no effort whatsoever. If you saw a recent video on Warren Buffett's famous $1 million bet, then you know that a simple investment in a fund that tracks the S&P 500 will, on average, pull in about 7.1% a year. Now, if you factor in dividend reimbursement, that number jumps to 8.5%. This is the classic buy and hold investment strategy. Buy one mutual fund, hold it, reinvest dividends, and boom! 8.5% average annual return over 10 years. Now that's a tempting return. It's kind of a siren call for the average investor because it's easy and it makes you feel like a winner after all. Plus, Buffett won the bet and proved the effectiveness of the plan. But, like Odysseus, you need to plug your ears to that call and focus on tweaking the strategy to maximize your return so you can earn an extra 3.5% on average. Of course, you're thinking, why should we jeopardize that bird in the hand for a lousy 3.5% extra every year? Especially if that means we have to pull ourselves away from Netflix or HBO Max for 20 minutes each month to execute big league trades on the frightening web page of a discount stockbroker. Here's why. It adds up. Like, it really adds up. Let's start with the rule of 72. If you haven't seen our video on this, then check it out. The rule of 72 shows that the number of years it takes for your money to double comes down to the number 72 divided by the percentage rate of return. So, at an 8% return, your investment would double in 9 years. Make that number 12%, and it doubles in 6 years, effectively a full 33% faster. Here's how most of us think about rate of return. If your $5,000 investment earns 6% each year, then after 20 years, that investment would be worth $16,000. So we assume that a 12% rate of return would double that. After all, the rate of return is doubled, so the overall return would be too. But that's forgetting about the beauty of compound interest. If you had $5,000 invested at 12% for 20 years, the investment would actually be worth $48,000. That's 3 times the return. That's compound interest. I guess it's true what Einstein said about it being the 8th wonder of the world. So obviously, the rate of return matters. But what about just a 3.5% higher rate? Let's do a side-by-side analysis of the 8.5% return from the buy and hold strategy compared with the strategy that returns 12% a year. Here are some starting assumptions. We're going to start with $5,000 in the account. We're going to add $100 a month, or $1,200 a year. In option A, we're going to earn 8.5%, while in option B, we're going to earn 12%. And finally, we're going to look at a 20-year timeline. Now let's start with the 8.5% return. After plugging in the numbers and settling our rate of return, we can see that after 20 years, we would have $83,612. Now keep in mind that after that time, our personal contributions would have been $29,000, which means that close to $55,000 is compound interest. That's not bad at all. But look at what happens when you make it 12%. After plugging in the numbers and settling our rate of return, we can see that after 20 years, we have $134,694, and our contributions did not change. It stayed steady at $29,000. The only thing that changed was our rate of return, which generated a full $51,000 more than the buy and hold strategy. Now let's say that you're young and hip and happening and you've got 40 years to play around with. That's a heck of a long time, but consider this a retirement account for the 25-year-olds out there. At 40 years, the buy and hold 8.5% plan brings in $485,000, while the 12% plan brings in $1.385 million. That's an additional $900,000 that you're leaving on the table if you forego that extra 3.5%. Now, do you feel like skipping out on $1 million? Because I sure don't. Now, please note, we're not accounting for trading fees and commissions or any additional tax bite from generating those short-term capital gains for those trading in a traditional taxable account. Now, that all does need to be taken into account, but I think you'll agree that we are still talking about a significant difference in payday at the end of 40 years. Here's another way to look at it. Take that additional $900,000 you generated by getting a 12% return and divide it by the number of years, 40, and you'll get $22,500. Think of that as the income you'll be receiving for each of the 40 years that you work that strategy. You put up $5,000 once, then you add $100 a month to your account, and you generate, over the long haul, an average of $22,000 a year. That's like having a second job that requires about 20 minutes of work each month and pays you $22,000 a year. Of course, there's the condition that you have to wait the full 40 years for the payout. But go back to our question from the beginning. Why should we go after that lousy 3.5% extra? I think the answer is clear. And what's great about this is you don't have to go become a professional stockbroker to adopt a strategy that will consistently earn 12% on average. You can follow a straightforward plan that involves index funds, market rotation, and a cash trigger, all outlined in the book The 12% Solution by David Allen Carter, and you can become a rock star investor and enjoy the wealth that comes with that extra 3 to 4% each year. So that you don't miss out on videos helping you build your wealth and increase your financial security, be sure to subscribe to this channel. And also, feel free to leave us a comment about what you would like to see us cover in future videos. Thanks for watching, and good luck.